welcome to this week's episode of Policy and Profits. I am Antoni Esposito, founder and CEO of Ascalon 6 Capital. I am joined once again by my good friend E.J. Antoni, head economist at the Heritage Foundation. E.J., how are you today, my friend?
Anthony, another busy day full of data dumps between the federal government, the Federal Reserve, a couple of private sector entities like National Association of Realtors and the like. So another very busy day of digging through the data. How about you? How are you doing?
We're doing fine. We're doing fine heading into the month and started off green as far as P&L, which is good. We hope to remain that way, but the markets are crazy. There's some underlying irregularities, which we're going to go through in the second part of the show when we talk about the profits. But you mentioned the Fed, and I'd like to go into the Fed with you to start. Obviously, Mr. Warsh had his first Fed meeting 2 weeks ago. The minutes were released yesterday. And a few things came out that I'd like to speak to you about and get your take on. Mm-hmm. So it talked about, we have that actually cut one. The FOMC minutes were released. New Fed officials saw a case for a rate hike, but decided to hold back. Inflation risks remain elevated, while labor market risks eased slightly. 9 officials see at least one 25 bip hike this year, with 6 seeing 2 hikes after 9. Another 9 see no more of a cut, no move or cut. Warsh declined to submit a rate forecast. We know that. And AI-driven demand, energy prices, and tariffs were flagged as inflation risks. The Fed is split, but the minutes lean hawkish. So here's my question. We've heard about a few different things. We've heard Warsh talk about the balance sheet and reduction of the balance sheet as a way to kind of pull liquidity out of the system and control inflation. Mm-hmm. We've heard about rate cuts and rate hikes. We've heard about productivity from AI being a deflationary pressure, and Warsh has talked about this before. And we now have a kind of, somebody made a joke today on CNBC, which I thought was kind of funny, that they're not the Fed minutes, they're the Fed seconds now. So as we move through this, I have one main question for you. Where are we as far as the risk of a hike or a cut? And I'm gonna. That's part A of the question. Part B is this. We all know that the government can't afford higher rates. We simply can't pay the bill on the debt that we have outstanding now. Yeah. Can the Fed, what is the Fed's position on rate hikes versus cuts? And can we actually afford to have higher rates in this country? Is that even a possibility at this point? Or will the finger be on the scale to make sure by hook or by crook that we do not see higher yields and higher rates?
Well, to take that last part of the question, Anthony, that is my fear, that it is going to be by hook or by crook, that they're going to try to keep yields down, that we're going to see yield curve control and a whole host of other kind of dirty tricks, really. Because you're right, we can't afford to pay any more on the debt. The debt is continuing to go up. We just had a 30-year auction, which we've had some bad tails recently. Now, this one didn't tail, actually. It stopped through. So you might say, okay, well, that's great news. The problem is, I think part of the reason why it did stop through is after 3 ugly tails, the Treasury said, we're not taking any chances anymore. And so the initial offering was a pretty darn good yield. This is, and again, even with the stop through, this is the highest yield going all the way back to 2007 for a 30-year auction. So that I think puts it into some perspective. So not only are rates the highest in roughly 2 decades, but the debt is way bigger to boot. So it's higher rates on a bigger base. That's obviously the huge problem, as you know. Not telling you anything you don't know there. So yes, I agree. Huge problem there. We're paying way too much on the debt. I think they are going to do everything they can to try to keep that under control. So what does that look like in terms of Fed action? I'm not sure it actually implies very much on the interest rate front. The reason being the Fed has a lot of other tools at their disposal right now besides just the Fed funds rate, or the target range, I should say, on the Fed funds rate. Whether it's going to be outright securities purchases or sales, or whether it's going to be going back to using overusing the repo market. again, they have a lot of different tools at their disposal there. So I think we might see a continued reliance or maybe a re-reliance, a re-escalation in how much they rely on some of those other mechanisms. Does this conflict with Warsh wanting to get the balance sheet down? Yeah, to a certain extent, it definitely does. So that's why I would not be surprised if you continue to see the reserve management or whatever other euphemism they want to use for these T-bill purchases. You might very well see that continue, Anthony. But what you can see, what you might then see is the MBS runoff that might accelerate. With
Okay.
MBS, unlike T-bills, where you can literally just allow the stuff to run off and just be constantly repurchasing because the maturity on T-bills are so short, right? The longest one is 52 weeks. It's the longest one.
Okay.
With the MBS, they have plenty of stuff on their books that's a 30-year term.
Yeah.
So and again, even if that was bought all the way back during the GFC, that's still going to be on the books for years.
Yeah.
So that's why when it comes to something like the MBS, there's a lot more management involved there where you see outright sales and outright purchases. What I'm getting at here is that there's no reliance whatsoever on the actual security's maturity date to manage that. It is, again, it's a lot of direct sales and direct purchases. It's going to be very easy for them then to ramp up the rate at which they are running that off because, again, it's really sales. It's not simply allowing the securities to mature. Some of that is happening, but a lot of it is, again, those direct sales. So if they want to run off the balance sheet faster, if they want to use that to soak up liquidity and get some cash out of the system, I think MBS becomes the prime target. So then what's the real world implications there? Well, you're not doing anything to put up interest rates on treasuries because, again, like you correctly started this with, Anthony, we're trying to keep yields down on that front. But what's it going to do to the mortgage market? It's only going to put upward pressure there in terms of those interest rates. Look, there's no good way out of this, right? The Fed really painted itself into a corner over the last couple of decades,
Yeah.
and Warsh has to deal with that now.
Let me ask you a question. I'm going to put you on the spot here.
Mhm.
And we're going to go into some market really interesting dynamics of the market as we currently stand, because this squeeze up has just gotten out of control. The U.S. markets are, in my opinion, just so irregular. I use the word manipulated carefully, but
Well,
they're just
can I interject there, Anthony, real
yeah.
quick? One of the things that's just blowing my mind right now is what we're seeing with oil, right? If you look at the position we are in today in terms of oil versus where we were 2 months ago, we are so much more vulnerable. The Cushing facility is at tank bottoms. In other
Mhm.
words, it's at 20 million barrels. That sounds like a lot, but you can't bring that any lower
Mhm.
without damaging infrastructure or seriously impacting the quality of the product because
Yeah.
it's like when mechanics before modern fuel filters in your car, mechanics used to tell you don't ever let your fuel get too low because
Yeah.
if you do, your fuel pump's going to start sucking up the debris and the gunk that's in the bottom of the gas tank, right? Well,
Yeah.
okay, imagine that on a scale of millions of gallons of crude in one of these giant tanks. That's why there's a minimum barrel requirement at Cushing. So again, you can't drain that any further. That's at the bare minimum. The Strategic Petroleum Reserve is in a much worse place now than it was again 2 months ago. So by all accounts, given the reclosure of the Strait of Hormuz, you should be seeing a bigger impact on oil today, not a smaller impact. So
Yeah.
I'm right there with you when I look at these markets and I say, what the heck is going on? From a strictly supply chain perspective, this makes zero sense whatsoever. And that's looking at data, whether it's the supply chain pressure index from the New York Fed, whether it's S&P Global's
Yeah.
supply chain data. I mean, you name it. Any of the numbers I look at just make absolutely no sense today in terms of this market reaction that you're talking about.
Yeah, so here I'll put you on the spot with the energy markets and with the equity markets. Obviously, the physical market is different than the paper market, and as we look
Mm-hmm.
at the futures and we look at the action in the futures, it has been subdued and pressed down for months now. If we look
Mm-hmm.
at the equities market, it has been supported. There is a phantom bid. We call it on the desk now a phantom bid to the market, where our signals are showing a real turn and shift down, momentum trend break. and we get to a spot where we would normally be adding to the short positions, and though it's almost like it on a dime, there's a bid that comes in and we see the lift and an acceleration to the upside in equity. So my question to you is this, and it's a really pointed question: is there a facility at the Treasury or the Fed where they could literally be selling oil contracts? I'm going to throw front month VIX contracts in there as well, because I believe that there has been a lot of artificial pressure down on the VIX. And there are some reasons why the VIX is kind of broken at this point and as low as it is. But the curve, I've been watching the VIX curve and trading it for over 15 years, and it has never acted the way it's acting. And is there a facility for the Fed or the Treasury to be buying, to physically be buying assets in the market? I know there was the plunge protection team, which was always, supposedly started under Reagan, and they would step in and they would buy futures or buy stocks. But is there a way for the Fed or the Treasury functionally to be buying stock, buying futures, buying levered ETFs, and letting those dollars go even further, or selling oil and VIX contracts? Is that even possible?
Well, if we look, Anthony, if we include all the different partners, or maybe you might want to call them counterparties, at not just the Treasury, but maybe even more so at the New York Fed, once you include the fact that the Treasury and the Fed, New York Fed typically, can work with those different parties, or partners or counterparties, again, whatever we want to call them, then absolutely, it is not only possible, it's been done before, where government can get into these markets and can try to, you can call it providing a safeguard, whatever the case may be, whether it's a price floor or a price ceiling. Yes, it's certainly possible. And again, not only is it possible, it's been done before. Maybe some people want to call it outright manipulation, whatever the case may be. It's definitely an intervention.
To what extent? Like, we have market cap on the S&P 500 is, don't quote me, I believe it's somewhere around $70 trillion. I'm pretty sure that that's the number. We have a $70 trillion market cap on the S&P 500. To what extent can the government actually intervene here? And there are ways for them to lever up, and there are ways for them to get into less liquid instruments and actually create more movement per dollar than in other instruments. But to what extent can they actually get involved here? Are we talking about trillions of dollars that can be put to use and pulled out? Are we talking about billions, hundreds of billions? What do you think is the intervention level, the magnitude?
So it very easily can get into the trillions of dollars because of that leverage component that you mentioned there, Anthony, right? And we've discussed before. You've articulated really, really well how people are levering up to buy Intel, for example, right? You're using a relatively few number of dollars to put a heck of a lot more dollars to work in the market with those equity purchases.
Yep.
But I think actually the bigger effect is psychological. I liken it to in October of 29, and I'm not trying to draw like a parallel here, like we're going to have a 29 style crash. That's not what I mean. It's just an example that pops to mind because you had partners at J.P. Morgan and Company who went across the street to the stock exchange during a couple of the days of panic, and they went out and they basically went out and started bidding up shares, right? You had stocks that were plummeting dozens of points per trade. That's back at a time when dozens of points were a lot, and then they would walk in there and offer 30, 40, 50 points higher than the last trade, and a lot of those trades never even got executed. In fact,
Yep.
most of them never even got executed. But it did, at least for a time, provide a kind of calming presence to the market when people were afraid that there would be no buyers at all, which is what happened on that infamous Thursday and then Tuesday. You had times when literally there were no buyers at all. There were only sellers. And so again, it provided more of a psychological impact than anything. But again, that's just psychological. In the long run, the numbers win. And eventually it got to the point where people realized there are still more sellers than buyers, and prices continued to fall thereafter for months.
Yeah, I think in the end, anyone that doesn't think the market is larger than any government can be is kind of fooling themselves, right? At the end of the day,
Right. Right.
rates will go where the market decides rates are going to go, and equity prices will go where the equity markets decide that they're going to go. And it is a beast, and it's you can contain it, but it'd be hard to control it over the long term. I think
Hmm.
that I do my personal feeling is that there's been a very large amount of market support over the past few
That's a
months.
charitable way to put it.
Yeah, it's very supportive of equity prices and very and kind of like a lid on energy prices. And look, you can hear it from President Trump. He can't have a conversation about the war in Iran or really anything and not mention the market and the fact that the market's at all-time highs and the fact that crude is back where it was pre-war or close to pre-war levels. So it's definitely front of mind for him. He even mentioned, 2 weeks ago that he had to go into negotiations because he was worried about a global recession, and he was worried that we were going to run out of crude, which I'm not quite sure why he made that comment. Um, but I do give him a little bit of grace because it's been quite a stretch, and he does handle quite a bit of quite a bit on a day to day, much more than any other president has. That said, I think that
Hmm.
the intervention and the support for the market is kind of running. It's running a very dangerous, slippery slope. I think when there's that much intervention, you could wrap the onion so tight that you actually smash it. And I think that's where we're heading. I don't think that this lasts forever. And I think the longer we kick the can, the more disastrous it's going to be when it actually returns back. But that that remains to be seen. One of the items in the market, the underlying structural problems I have with the market now, aside from leverage, which is really a massive concern of mine, whether you mark, the market cap of the S&P towards GDP, which is at an all-time high at 250%, or you mark the financing expense at the prime brokers, which is at all-time highs, cash on hand, which is at all-time lows, the leverage in the market, the leverage products in the market, the leverage that retail is using is scary. And I think that leverage is just fuel to a fire, which South Korea is actually dealing with now. I mean, if you look at the Kospi and the overnight, they're up and down 10% on any given night. They're actually talking about South Korea. The brokers are looking at raising margin limits to 100% because they're
Wow.
afraid of what's actually happening. So the Kospi is interesting. It's an index that's 50% two names. It's Samsung and Hynix. Hynix, by the way, is going to issue an ADR, which is 7 times oversubscribed in the U.S. This week. So that just
Wow.
tells you where sentiment is. They're actually marking it over 3% above the close in South Korea for the U.S. Open. So obviously no parity there because the exchange isn't open while we're open. It's not like a British Petroleum where you can arb and there's a parity between where it's trading in London and where it opens in New York, which is
Hmm.
actually how I started my career many, many years ago, arbing London and New York. But um, so that's going to be the mark on the semi side. So back to the leverage, we're seeing a lot of different ways leverage is used. And we have cut number 2, which actually shows a great screen available on Bloomberg, which we use quite extensively here during the day. This is actually the OPX function in Bloomberg. And what it's giving you is same day options in the SPYs. So zero
Hmm.
data expiration in the SPYs. Obviously, options are levered at 100 to 1. You have massive amount of leverage you can gain by being in these options, but it's creating an underlying theme and an underlying pressure to the upside in equities by the retail investor, massively levered. So what is that? How does that happen? Um, Most of the options being bought on up days are calls. So you can see from this chart, this is the open interest in options, zero data expiration in SPY. Currently, about 70% of all SPY options are zero data expiration options. This is why the VIX is essentially broken at this point because the VIX is measuring vol
Wow.
30 days out and then 30 days out from 30 days out and 30 days out from 60 days out as you go along the curve. 70% of all SPY options volume is zero data expirations. 80% of equity volume is coming from market makers who are delta hedging those options. And 60% of that volume is coming from zero data expiration. So essentially, what I'm saying is there is a massive amount of gambling going on by the retail investor, and they're using these options. So then you say, okay, so what's the big deal about using the options? How is that affecting the the equities market? Well, there's a thing called a delta hedge. And when a client comes in, and all these gray lines, by the way, on this chart is open interest and calls. So you can see as moving up the scale in price on the SPYs, it's all call options. When someone comes in and buys a call option, all right, it puts the delta, the delta hedge for the market maker. I'm going to try and keep this as streamlined as I can. The market maker selling that call needs to buy equities, the underlying. In this case, it's the SPY, so it's the whole basket of SPY, the SPY ETF. The market maker needs to buy the SPY to stay delta hedged so that they don't lose money on the trade, right? So if they're short call, they're short delta, so they need to come in and buy the equity underlying. Okay. So as they go to buy that and price continues to move higher because they're buying and they're supporting the equities, gamma, which is the rate of change of delta, I'm not trying not to go too deep, gamma actually starts to increase. It squeezes those market makers higher. So as the price actually moves higher, it actually creates more demand so that the dealer can be delta hedged to 1 when those options go in the money. Once they're in the money, there is no more rate of change of gamma because it's got to 1 and you don't go above a 1 delta. So now it's a 1-to-1 change, and then we continue to move down. Now, if there are additional calls higher and the price of the SPY continues to move higher, well, guess what? The dealer needs to remain delta hedged, so they need to buy enough of the SPY to cover their short exposure based on delta. Gamma continues to squeeze higher. Dealer continues to buy SPY. SPY continues to roll higher. Now the SPY hits another price point, another level of calls where they're short. Guess what they need to do? They need to buy more SPYs. They need to get to a delta of 1, and everything starts to squeeze higher. So as we talk about this gamma squeeze, this is a real thing. This is a real thing that is part of what has become a casino. Now, I don't mean to sound like I'm disgruntled with the markets. The markets are what they are, and you trade them as they are. But I would say that this is a great example of massive, uneducated leverage that is walking through a landfill. There are landmines everywhere here, and it will continue to work until it doesn't. The equivalent phrase and the old school phrase is you're picking up pennies in front of a steamroller, and you'll continue to pick them up, and you'll continue to be up or down on balance, because I guarantee you that the retail investors that are pumping into these options are losing as much as they're making, but they're continuing this process. So you can pick up those pennies, but at some point your hand's going to get caught under the steamroller and you're done. I think this is part of the problem with the market. This is becoming a casino. This is a complete gamble. When you're buying an option that expires in 1, 2, 3, 4 hours from the time you're buying it, and that has become 70% of all the SPY open interest on every line, that's the volume. We have a real problem. And I think that problems like this don't resolve themselves with grace. They resolve themselves with a sledgehammer. And I am concerned that this is part of the problem on the squeeze up. It disguises itself as real demand. And on the way down, it's going to be really, really ugly, along with the leverage and the 2 times ETFs, the 3 times ETFs, the inverse ETFs, the margin loans, the bank loans, everything that's going on is becoming very concerning for me personally. This is just one thing that happens every day. We watch this gamma squeeze every day now. And these charts are great because they're dynamic, and they will move within Bloomberg, and you'll see the gamma increase as price just moves along. It just grinds along and it gets pushed up. It is not real demand. And the demand, if you want to look at the semis and these levered ETFs, it's the same type of problem. It's just a different way of realizing the problem. The problem there is for every 1 share of NVIDIA that you're paying for, the ETF has to go out and buy 4 shares based on your 1 share of capital. And that's a problem because that overextended leverage is creating massive moves in the semis, which is creating massive moves in the market, which is creating massive moves on the gamma squeeze, all based on leverage and gamble. It's a dangerous scenario. It's something everybody should be aware of. If you're playing the game, be careful. I personally will trade the market that's given to me, but I and my desk is prepared for a very significant sledgehammer to drop on this game at some point. It may be next week. It may be in 6 months from now, but at some point, I know that this roulette wheel will fall off the table, and I think everyone needs to be prepared for that.
So Anthony, I know we've talked in the past about like what actually is the What is the pin that pops the balloon, right? And in the past, we've said, what's some kind of liquidity event, which could be something as simple as Bitcoin has a truly horrific day and falls below 40K. And now a bunch of people need to raise cash. And so they
Mhm.
have to liquidate other positions, and that starts the unraveling, right?
Mhm.
Is that still what you think is really ultimately what lets the air out of the balloon here?
So I think it could be, right. I think it could be. It's going to be it's going to be some sort of source of funds or capital call. It's going to be
Hmm.
some squeeze out. I think the culprit will be leverage. I think what Jenga piece that gets pulled to start to unravel could be one of a couple of things. I think Bitcoin does stand to be a real issue if we start to break, and I think that's part of why it's being defended. I don't think it's being defended because there's real demand at 60,000. I think it's being
Yeah.
defended because if it breaks, there's going to be a real break in available capital. Um, a larger a larger risk that I see that I'm watching very carefully, and we talked about it last week, is the Japanese yen and the yen carry trade. We have
Mm-hmm.
the across the globe, the most popular carry trade on the institutional level is to short the yen, which is a very cheap currency, receive dollars in return for that short, and then use those dollars to buy risk assets. So for very little in funding, you can gain dollars, basically create dollars, and then go out and buy assets that you expect to get a return of 8%, 10%, 15% on. Um, I think the real danger here is the yen is at very, very low levels. We're up at 162 now in the yen. I think we said last week that the yen hasn't been this weak since the first Top Gun was out in the movie theaters originally. I guess that was 1986. Um, you know, we have a situation where if the Bank of Japan, and I'll caveat this and say, I do believe that Secretary Bessent has spoken to the Bank of Japan and said, mind your P's and Q's. We understand, but it is what it is. But if
Hmm.
the Bank of Japan was to start to defend the yen, which I don't know that they can't for too long, there is a self preservation aspect to this story. If the Bank of Japan starts to defend the yen and they bid the yen up or down because of the conversion, but if they strengthen the yen, there could potentially become a real squeeze. And if we see a squeeze in the yen and we see people unwind the carry trade, they're going to
Hmm.
be forced to sell their dollars, which means they have to sell whatever assets they bought. They make that sale, they take dollars in, and then they return those dollars into the system and they cover their yen. They essentially have to buy the yen back, so strengthen the yen. Um, that short squeeze is a real thing. It's something that we watch here every day. We're watching yields every day. We're watching the yen every day. We watch the Dixie every day. Obviously, we're paying attention to all the indicators. The last time we had a real squeeze in the yen was in August of 24. The S&P was down 8% in 3 days. Those are real numbers. That was the effect of the unwind of the trade because it happened so quickly.
Hmm.
Am I saying it's going to happen now? I'm saying it could. I'm just saying it could. If no one's talking about it, no one's looking at it, you have to turn that rock over and think about it. Um, and all of these kind of games that we're playing on the side, those side bets get wiped out pretty quick. And anybody that's a buy the dip person and lever it up, you can buy it once, you can buy it twice. But if you're seeing a real market event and you're seeing a real cascade of selling, um, you can be wiped out pretty quick, especially if you're levered. And your last trade will be the red button, not the green button, and that will be a serious situation. So Bitcoin for sure, I'm watching. We have it up on the screen. We watch it every day. The yen carry trade for me is definitely a concern. And then it's the leverage. It's how do these things eventually unwind because at some point they're going to unwind. I mean, I understand the fundamental bottom up analysts. They have great reasons why Intel should be up 8,000% in 2 weeks. You can come up with all the reasons you want, but if you look at the structure of the market right now, it is about leverage and it's about gambling, and that's where we're at. And for me, those are flashing red signals. Now, again, we're traders here. We're generally contrarian, and we swing trade. And some of our trades are little jabs and little wins, and some of our trades are bigger bangers and left hooks, and that's fine. We'll trade the market that we've been given, and we understand the structure of the market, and I understand how irregular the market is. But at some point, we will mean revert. And when we mean revert, it's going to be a sledgehammer.
Yeah, and kind of tying this back in to where we started the conversation, talking about how basically the ugly position the Fed is in, how Warsh is in a bit of a straitjacket right now. I mean, the central Bank of Japan rather, is even worse. I mean, you look at their, I don't like using debt to GDP, but let's say debt to, um, uh, or cost of servicing the debt rather to their GDP, right? That's a flow and a flow versus a stock and a
Yeah.
flow.
Yep.
Um, when you compare flow to flow, even if you want to use stock and flow, but let's use flow to flow, the ratio is way worse in
Yep.
Japan than it is here. So you think our Fed, you think our central bank is in a tough spot? I mean, it speaks to again the really tight spot that they are in over in Japan,
Yep.
and the things that they are trying to balance. And I don't know how you can balance them because you're talking about things that are fundamentally at loggerheads there.
Yeah. Yeah. Look, we're in a really tough situation, and you can throw the war on top of that, and the risk there, which is really being downplayed and not priced in. I mean, there's no way you can tell me that we're pricing in the straits being closed and a continuation or a re-escalation of violence in Iran. I mean, really, we haven't stopped with the violence in Iran, and we haven't gotten back to normal Hormuz traffic at all. Um,
Yeah.
we seem to not price anything in, and I have to feel like the lack of pricing this in and the casino, I mean, that we've stepped into is a really dangerous combination. And again, when governments and entities don't let free markets be free markets, you're not stopping the inevitable price discovery. You're just postponing it. And a lot of times you're making it worse. If this elevator was supposed to go to the 10th floor and then we were going to jump out the window and you push it to the 28th floor, we're still jumping out the window. We're just doing it from a much more dangerous level. And I think that's really the best analogy I can come up with where we are. I'm not saying we're not going to the 40th floor. I don't know. But I will tell you that, we are prepared here and we're very careful in watching our indicators and our momentum trend indicators on multiple timelines to try and be aware of where we're headed in the near term and then where we may be headed beyond that. Because that, for me, the bigger trade, the bigger risk and the bigger trade now is to the downside. It is not to S&P 8500. It's just not. The bigger risk here is that, we retrace what we just gained from the end or the apparent end of the war back in March. And I don't say that to be, hyperbolic. I'm just saying like we could easily retrace that. We could easily retrace 50% of this move and people would be out of their minds because no one
Mhm.
believes that we can actually go down. So we can kick the can down the street, but eventually it's going to catch up. And I think to your point, that's exactly where we're at. There are too many fireballs being juggled right now. So
Yeah, I mean, ultimately, right? The only thing that actually justifies equity prices are future earnings, right? So either earnings have to catch up in a big way, or those equity prices are going to catch down.
yep.
Um, and I just don't know how. When you look at those PE ratios, I mean, you can believe all the productivity stories you want about something like AI, and trust me, I believe a lot of them. You
Hmm.
still don't justify those PE ratios, right? So again, either earnings have to catch up in a massive way, or those prices catch down, one or the other.
That's what we're talking about. And we have great stories here as far as earnings
Hmm.
and the projected forward numbers. But if we look at Intel, let's just look at Intel. The 1 year return on Intel is 380%. Okay. The price to earnings ratio right now is 448. It's 448, the PE. I mean,
Well,
I don't know
and
what
how
else to
much
say.
and how much of that gain was because of the government liquidity infusion that unfortunately, look, we thought this was going to be done to build a bunch of chip factories here and have a bunch of domestic investment and have more jobs and secure supply chains and so on.
Yeah.
In reality, it went to things like stock buybacks. Now, not entirely. I'm not trying to be like too flippant here,
No.
but the fact is the investment did not turn into what we wanted it to turn into. And unfortunately, a lot of what it did was, again, just simply increase the share price.
Yeah. Look, we went
Which
from
for the taxpayer, I mean, like if the government were to sell, now they can't liquidate the entire stake. It
no,
would do bad
yeah.
things to the market. But if you could somehow liquidate the stake today, right, you would at least have a positive return for shareholders. So it's
Sure.
better than GM, I suppose.
Listen, I get the point. I get Trump's point. I get the approach, but you have a stock here that its 52-week low was 18, its 52-week high was 142, it's trading 112, its PE is 448, and its forward estimate PE is 103. Now, I'm not a fundamental analyst, but I can tell you that 448 is a PE on a stock that's up 380% on the 1 year return. That seems pretty rich to me. I don't know. I really can't understand why anyone would buy this and think that this is of value or try and defend this name, other than the fact that it keeps going up. It's the greater fool theory, and we look at the I won't even get into the spending and the debt creation and the issuing of the capex meltdown that we're looking at for AI. But when you look at the value of these companies and you look at the overspending on a new technology, which is exactly what we saw back in '99, and you look at the PE back in the cyclically adjusted PE back in '99 and the cyclically adjusted PE now, is the only two times in history that we're at this level. The only two times in history. So if you want to say that is not in and of itself reason to take pause, well, then keep picking up the pennies in front of the steamroller. I think it's great. Have fun. I wish everybody luck. But we're definitely in a very unique environment. We're in a market. I've been trading for 30 years. I've never seen a market like this, to be really honest with you. And that includes 99, 2000. That includes '08. That includes, COVID. That includes everything. I've just I've never seen a market like this. So I think as we move forward, EJ, I love having the conversations with you. You're always a wealth of knowledge.
Oh,
I want to
likewise.
keep on this. Oh, thank you. I want to keep on this Fed watch, because I think Warsh is gonna be very interesting to watch. He's gonna have some different ways of doing things and expressing things, and maybe not expressing things. You are plugged in there, and I love leaning on you for that knowledge and insight. So thank you very much again for the help. At real EJ Antoni, the best X handle out there. I'm on it every day. The charts, the analysis. I'm serious. The charts and analysis are fantastic. So thank you. Everyone should be checking that out. I'm at CMT_Anthony if anyone wants to check that out. The website is ascalon6capital.com. EJ, my friend, thank you very much. Have a great night, and I will talk to you soon.
Same to you, Anthony. Till next time.
Thanks, man.